This is Kyra Ahuja from Emkay Investment Managers, and I would like to extend a warm welcome to all of you joining us today on this webinar. I am truly delighted to have each one of you on the call with us today, and I assure this MK Edge series will be truly insightful and help us decode the current market's dynamics. Today we have with us Mr. Manish Sonthalia, a name that needs no introduction. With over 3 decades in the market, Manish sir has indeed navigated many cycles, and this is just another opportunity. A commerce graduate from St. Xavier's, he is also a part and a member of the Institute of Cost and Works Accountant of India, the Institute of Chartered Accountants of India, and the Institute of Company Secretaries of India. He has completed his MBA in Finance from IIS WBM. In his previous assignment, Manish sir served as a CIO for PMS Alternates and Offshore Funds of Motilal Oswal for over 18 years. His research paper on the Indian markets, A Rising Consumer Class, was published in the Global World Economic Forum in 2010. Manish sir's views are frequently sought by leading media channels in India as well as globally. Manish sir has joined MK as a CIO and fund manager for the MK India's Golden Decade of Growth Fund and been with us for over 1.5 years now. So a warm welcome to you, Manish sir, to the webinar today.
Thanks.
To start with, sir, we would like your views on the current markets, both short-term and long-term. And we will also seek insights into the Golden Decade portfolio and a peek into a few stocks that have done well for you. Yes? So over to you, Manish sir.
Thank you, Kyra. Ladies and gentlemen, a warm welcome from MK Investment Managers and myself. Thanks for sparing your time. It has been a tumultuous year so far from January the 1st. And obviously, last 5-6 months have not been that great. So exactly what is happening in the markets and why are we seeing what we are seeing currently and how do things look from here? These are the pertinent questions in everybody's mind. So from my understanding that this rally actually started in the middle of the pandemic when Government of India actually rolled out a lot of stimulus, right? Because lives were getting lost, livelihoods were getting lost. So in that backdrop, something needed to be done by governments all over the world. And that actually meant that government had to lend a helping hand to everybody. In that backdrop, actually fiscal deficits of governments, including India, went up significantly. At one point in time during the pandemic, Government of India's fiscal deficit was closer to 9%. And this I'm talking only just about the central government's fiscal deficit. So in that backdrop, what happened? All the 3 pillars of the Indian economy, basically consumption, savings, and investment, got a massive leg up. Why? Because consumers were not seeing any major increase in income, but they were seeing an increase in easy availability of money, which is basically easy availability of credit. And the cost of credit also was kept very, very low. So in a case of a very benign liquidity situation, household leverage went up. Household leverage means individual people's leverage went up. The incomes did not go up. As a consequence, what happened was that consumption went through the roof because there was availability of money and you didn't have to repay it very, very quickly. And the cost of that money was very, very low. So there was a binge consumption because COVID ended in 2022, but all the consumer names, actually consumer items, consumer sector went through the roof, whether it was automobiles, whether it was home improvement like paints, whether it was leisure, travel, restaurants, QSRs, every sector did very, very well. And consequently, even the consumption sector in the stock markets did very well during the pandemic. Come to the second pillar of the economy, which is basically your savings. And Government of India extended a moratorium that nobody had to repay the loans that were taken and nobody had to make provisions for NPAs during that pandemic period. In that backdrop, basically, your credit growth was ensured and there was growth, but there was no provision line item. The banks did well. Even in the stock market, the banking sector actually did very well on account of growth, plus no moratorium on provision, so no provision line. Come to the third pillar of the economy, which is basically investments. Government put in a lot of money in the system through investments in roads, railways, and defense. These were the three major items where government of India actually pumped a lot of money. Consequently, all this money was being pumped through the public sector units. The public sector units did very well in the stock markets. All the infrastructure construction companies did very well. Defense companies did very well. Railways did very well. Road companies did well. So all the three pillars of the economy was firing on all cylinders during the fiscal deficit, thanks to just one specific reason: government had expanded its fiscal deficit. In the year 2022, when COVID ended, then everybody had to resort back to normalcy, which means that the excess leverage that was there in the system, or fiscal deficit that was created in the system by using the balance sheet of the government, has to be reverted back to normal, which means it would entail a shrinkage of the fiscal deficit. We have seen that last year the fiscal deficit number was 4.9%, and at one point in time during the pandemic it was 9%. Now, previous year, which is fiscal 25, it's going to be 4.9%. This year it is 4.6%, 4.5% for fiscal 26, and going forward to 4%. So what is happening is that government of India is shrinking its balance sheet, shrinking its loan. The corporate sector, which made huge amounts of money, and also in 2019, government of India extended a reduction in corporate tax rate from 32% to 25%, ensuring that, or let's say anticipating that, the corporate sector will actually go about and do some major private capex. That also did not fructify to the extent that it was anticipated. On the other hand, the corporate sector also reduced their leverage on the books, which is shrinkage of the balance sheet. So corporate sector was deleveraging, the government was deleveraging, only the household leverage, which is individual loans, were going through the roof. And in the second quarter of fiscal year 25, this came to light. There was already some stress building into the system because RBI had clamped down on liquidity and unsecured credit, personal loans, credit cards, and so on. And in that run up in quarter 225, we actually saw the MFI sector actually blow up. Then it came to be understood quite well, adding 2 plus 2 together, that household leverage, the income had not gone up, the leverage has gone up. Now, because of very high inflation and taxes, the middle class was suffering quite a bit. The top 5% of the population did not have any major impact because they don't seem to have major impact at any point in the economic cycle, just because they are very well to do. But the middle class in the base of the pyramid was feeling the pinch of no savings, no growth in income, no savings, and rising leverage. And this basically led to a collapse in the consumer sector just before the year was just getting along. Quarter 225, and the because of the consumption slackening, and because the government not able to spend whatever they had earmarked from the investment side of things, and even the banking sector, the provisions, etc., had reached almost at the lowest level and could not go down even any further than that, and it was about to rise. So all the three pillars of the economy was facing some sort of a stress. Corporate earnings growth, which was high double digits from 2020 to 24, collapsed to fiscal 25 at 5% or thereabout. It will be around 5%, 6% for the current running quarter, and year ending would be fiscal 25 around 5 to 6%. Going forward, because we anticipate that earnings is going to grow at 10 to 12% on the back of 6.2 to 6.3% real GDP growth, and your valuations on the market. How do we gauge about what is the fair value of the market, and when will the markets actually stop falling? So there's a match to it, and obviously the benchmark Nifty 50 is the indicator of where the levels could be subsiding, and this far and no further on the downside. That sort of a question is, when will it stop fall? So from that point of view, I think we are currently at around 22,800. And for fiscal 26, as things stand today, domestically, we should be looking at something like 1,200 rupees on EPS on the Nifty 50. And in FY27, if things go as per plan, like a 6.2 to 6.3% real GDP growth and another 5% of inflation translating into an EPS growth of 10 to 11%, then FY27, as things stand today, should be closer to 1,300 rupees. So the average of fiscal 26 earnings and fiscal 27 earnings should be closer to 1,250. And I think, give it 6 months out from where we are today, markets would be looking at closer to around 18 times on FY and the average of FY26 and FY27. And obviously, the median valuations on Nifty 50 over the last 10, 12 years has been around 18 times. And I think these are the levels for a 10% earnings growth. This is the best possible situation that you could give. And you will arrive at a level of around 22,000 on the Nifty. So on an indication-wise basis, I don't think that the markets will likely fall below 22,000, which is just about 2 to 3% from current level, 3-4% from current levels. Bulk of the pain in the broader markets has also played out. Currently, if you were to extrapolate broader markets valuations to where Nifty is, we are closer to around 16,000, 17,000 in the Nifty equivalent of where the mid and the small caps is standing today after a 25 to 30% correction in the month of January. So is it enough? Is the valuation really bottomed out as far as the mid and small caps is concerned? Maybe at the index level, no, but at many of the stocks levels, the valuations have broadly played out on the downside. So from that point of view, we can say that, bulk of the froth, as far as the market is concerned, whether large caps or mid and small caps is played out. Here I may be deviating away from the opinion of many of the great CIOs or fund managers, but I believe that having seen through many cycles and even seen the COVID cycle, which was actually a very brutal side on the downside, we actually saw some sort of similar situation when things were falling like nine pins and it was just about that there's no hope for anybody in these markets. That's really things turned around. So I think bulk of the people, basically weak hands, have actually thrown in the towel, and those who have survived this far are likely to survive even the next 6 months, staying on to their position. So from that point of view, I think the markets are extremely light, and it will be all about tol mol ke bol. What is the value of that particular company, and how you should be going about valuing. And please don't take, let's say, a 1 year point of view. Take about, let's say, 2 to 3 year point of view. As far as the broader markets are concerned, there's ample money to be made in India in this quest of a $3 to $4 trillion journey, $4 to $5 trillion journey that we are going to embark over the next 2-3 years. So from that point of view, I think there's not much to worry as far as the current markets are concerned. It does not really pay. And I have been in the markets for the last 30 years. When the going gets really bad, maybe that's the best time to pick stock. So from that point of view, I think that's one aspect that one should keep in mind. That bulk of the froth that was there in the markets closer to prior to January is broadly out, and one should actually have a brave heart approach as far as the markets are concerned when things are looking very gloomy and doomy. So from that point of view, there's two more things that needs to be seen. Is that when will the FIS stop to sell, or will stop selling? So I think it has to do with the currency, and we have seen, the last 4-5 years, RBI has maintained a pretty defensive stance on the Indian rupee, not allowing it to depreciate on the fear of not getting imported inflation into the country, and preferring inflation over growth. The new governor who has come in is letting rupee find its true level. And more than the rupee weakness, it is basically the dollar strength, because You have the 10-year yield out there at around 4.5%, and that's a risk-free yield. It's attracting a lot of dollars from all over the world back into the United States. So that is creating a scramble, selling emerging markets and going back to the US. Of late, we have seen the narrative coming out of tariffs, the narrative coming out of asset monetization of the US balance sheet on account of revaluation of gold reserves, so on and so forth. All this actually means that, to cut the jargon short, is that the dollar at some point in time is likely to depreciate. So we have already seen the US dollar from 108 dollar index from 108, 109 to something like 106. And mind you, if there is a tariff approach to the entire world, reciprocal tariffs or whatever, it's going to be quite inflationary. And from that point of view, if you have very high inflation, you're likely to see a weaker dollar because, and the whole approach to getting manufacturing back into the United States can't be true with a very strong dollar. So dollar has to depreciate either through bilateral talks or FTA agreements with trading partners and so on and so forth. And even government of India is attempting to having a bilateral approach to the entire US surplus that we have with the United States. Just that the tariffs don't hurt us too much. And all the major countries of the world will be following that approach. And selectively, the US might go in for free trade agreements and bilateral agreements to go about and selectively depreciate the US dollar with these trading partners. So from that point of view, I think we are of the opinion that India's situation is not that dire as is being made out to be. Only thing is that our surplus with the United States is around 45-50 billion dollars, and our deficit with China is around 150 billion dollars, something like that. 150 billion dollars. So what needs to happen is that we need to form joint venture with Chinese companies in India, and then maybe have a free trade agreement with the United States, so the entire problem of import and export can be balanced, so that we don't run into a balance of payment crisis, so on and so forth. So broadly, if the currency was to depreciate, we have already seen closer to 89 on the dollar, and thereafter it has again bounced back to around 87. So probably the Indian rupee has found its level in the near term, whatever it had to, and the long term depreciation of the rupee stands good at 3 to 4%. And all the earnings maths and fiscal maths of the budget, etc., there in the price, not too much to lose from the current levels. So that's my view, and I would believe that uh, as to what to buy in these markets. So over the last 1.5 years, it was actually a case of investment-related themes, your defense and railways, and capital goods and infrastructure that actually played out quite well. And this budget, basically, we actually saw a 1 lakh crore tax cut, corporate tax cut. Not corporate, sorry, individual household tax cut, individual income tax cut that we saw, and savings to the extent of 1 lakh crores. Now, based on marginal propensity to consume, if you have a saving of 1 lakh crores on account of income tax, and if the individual who gets that relief, saves 20% of that, that is to say that 1 lakh crores, 20,000 crores gets saved, and 80,000 crores get spent, then as per the formula of marginal propensity to consume, 1 divided by 1 minus MPC, which is 1 divided by 1 minus 0.8, that is 1 divided by 0.2, a 5 multiplier, which means a 1 lakh crore worth of savings in income tax on individual's account will create a multiplier to the extent of 5 lakh. So obviously the pendulum, and government basically has shrunk the capital spends that was budgeted for fiscal 25, and has kept at the same level at what was the revised budgeted estimates for FY26. So 11 lakh crores is what is being budgeted for FY26. So the exuberance around the investment related themes over the last 4 or 5 years is likely to subside, and there is going to be a euphoria on the consumption side of things. So consumption is basically the new sector to watch out for. Apart from that, I think export-oriented sectors like pharmaceuticals and IT, of course, tariffs and all are being debated. But mind you, in the case of pharmaceuticals, because there's such huge dependence on generic exports out of India, if they were to impose tariffs of 25%, then the cost of medicines in the US itself is going to be significantly higher, and there is going to be massive shortage. So in any case, if there is a shortage, the prices will move up and the exporting countries will take advantage of the increase in export prices. So I don't think a tariff on pharma is likely to work. Likewise, you could have exports of auto components, etc., being made through neighboring countries and so on and so forth. And because the rupee has depreciated, as far as the IT sector is concerned, there is hiring that is picking up. You're likely to see increased technology spends also come through. I think technology again is in a sweet spot. So technology, IT, technology, pharmaceuticals, banking is very, very cheap. The large banks are likely to meander the situation much better than the mid-tier banks. And from that point of view, both private sector and public sector banks offer great value. You also have the insurance companies, both the life insurance as well as the health insurance companies offer deep value. As the current valuations, you couldn't find insurance companies at a better valuation than what you're seeing it today. And I also believe that consumption will find its way into the portfolios, and discretionary consumption will be favored more than your FMCG just yet, for the simple reason that GST cut has not happened, income tax cut has happened, and of the 7.4 crore, 7.5 crore income tax filing, 6 crore people will have income of less than approximately 6 crore people will have income less than 12 lakhs. And this is the 6 crore people who are likely to benefit. So it's going to be beneficial more on account of discretionary items, those who are not so much dependent on roti and kapda, but beyond that. So it could be mobile phones, it could be air conditioners, it could be two-wheelers, it could be cars, it could be your mediclaim, it could be your leisure, entertainment, so on and so forth. So these are some of the sectors which are likely to benefit. All in all, going massively overweight on consumption, going overweight on pharmaceuticals, IT, equal weight on banks. I think the rest of the sectors will be underweight. So for me, at least, railways, defense, power, also to some extent renewables, though renewables is not exactly a massive underweight, but still an equal weight sort of a situation. Capital goods, infrastructure, these will be slightly on the underweight side. So that's how I actually position on the portfolio. And some of the stocks that have worked for us and we have taken profits off the table in recent times, and almost fantastic returns on some of these stocks were Paytm, which actually saw a price of closer to 850, 900 rupees. We actually, took a position in this company quite early in the cycle when valuations were closer to around 400 odd rupees. And we thought that, in the run up to the PhonePe IPO, the arbitrage and the valuations between these two companies were likely just too big. And the company was actually turning the corner as far as the uh, you know, payments business was concerned, the merchants, P2M side of things were concerned, they had already seen the worst at around 400 rupees. So I think 10,000 crores of revenue was of what we built in for Paytm in FY27, and break even from a 1,500 crore loss in FY24 to a 1,500 crore profit in FY27, largely played out to the extent at around 850 to 900 rupees. We actually took our profits off the table out here. The second company where we actually gained a lot was Bombay Stock Exchange. And obviously, we believe that financialization of savings is the great theme for the next 5 years, because in India, the financial sector actually drives the real sector. And within the financial sector, you have a tilt from debt to equity. And all equity platforms, leave aside the current short-term downturn in equity markets, but all platforms in the equity side of things for the next 4 5 years are likely to be great beneficiaries. So, whether it is wealth management platforms or AMCs or exchanges or repositories, I think they are buy on dip. So we had actually taken a position in Bombay Stock Exchange quite early in the cycle. And obviously the thesis has played out. They reported some fantabulous numbers on adjusted profits, leaving aside the contribution to the investor protection fund this quarter. Run rate for them on an adjusted profit basis would be closer to around 2,000 odd crores for FY27. And I think the market cap of the company at current levels were around 75 odd thousand. So on a 2 years out basis, basically 35 to 40p is justified. They will trade at a slight discount to what NSE will trade at, and NSE currently would be trading at around 4.5 lakh crores market cap. So 4.5 to 5 lakh crore market cap. So in that backdrop, we think that at around 75 or 1,000 crores, stock was very fairly valued, and we actually made almost a 70-80% returns on this stock. The third stock which actually gave us good money was Kalyan Jewellers. We sold quite early, even before these all controversies in the marketplace actually began, but at around 650 to 700 rupees. Again, the valuation, the growth in the company is going to be very good, even for the next 6-7 quarters at around 35-40%. But just that this whole gold price increase and the increase in lease rates or gold metal loan will mean that the working capital cycles for all the jewelers are going to be very, very stretched. And we all know that whenever there is an increase in gold prices, the propensity or the affordability of jewelers, affordability of consumers just takes a backseat for some time. So from that point in time, when I was selling at around 650 to 700 rupees, we're actually booking profits around 125 PE on a trailing 12-month basis. We were good booking our profits in that. On the contrary, what have we bought very recently? We think that Voltas is a good name on the discretionary side. There is going to be a very hot summer this summer, and there's going to be a short supply of ACs in the country. And obviously, during the pandemic, the size of the air conditioning, room air conditioners industry in India was around 75 lakhs, and currently we are at closer to around 1.5 crore. And even now, the penetration rate will be 9-10%. So we still have the doubling of possible capacity in the room ACs to be shared between 13-14 players. And obviously, it's an economies of scale business. It's a push product. You have to compete with 13 players. Everybody is vying for or fighting for market share. So the greater the discounts you give, the better will be your sales. And the more your sales, the better your margins are going to be. So it's a simultaneous equation, X and Y, two variables that you've got to solve at all points in time. The stock has corrected from 1900 to 1300 or thereabouts. We actually were good buying into this thing. So that was a very recent stock pick that we had. We also bought into an Eicher Motors, where the company actually reported very good profit growth in the third quarter numbers, 18% growth in profits. The silver lining or the best part on this company was that export figures of 10,000 units per month number has started to come through. And that's a very big thing, because for years together, Eicher Motor was stuck between 70 and 75,000 units. One could say that the mix has gone inferior and there's compression on margins, but believe me, a 24-25% margins is the best in the motorcycle industry. You take it across Hero, TVS or Bajaj, in the two-wheeler space, that's the best margin thanks to very frugal engineering of Eicher. And now that they are ready to launch the electric motorcycle in the 350cc segment and beyond, plus the exports contributing, plus valuations at very reasonable levels of around 27-30 times 1 year forward is a very good valuation to buy into for a 30% plus ROE business and a payout of around 25. So we are bought into an Eicher Motors. A few other stocks where I think discretionary items like liquor, etc., will do well. We are bought into Allied Blenders and Distillers Limited. This is basically the owner of the Shaw Wallace Officer's Choice brand. And again, the going has been very good. There's been an expansion in margins. On all of this, you're getting at a market cap of less than 10,000. $1 billion valuation for an Officer's Choice brand is a steal, according to me. Of course, the whole thesis is going to play out over a period of time. So we have bought into this, and plus we have also bought a health insurance company, the largest health insurance company in India, Star Health Insurance Company. We think that valuations again are very, very fair at current valuations, almost at rock bottom prices. They are going to take a price increase in FY 25-26, anything less than 10%, but there's going to be huge operating leverage that's likely to play out. So in this massive correction in the stock market, these are some of the sectors that we have actually bought into. So all in all, this is broadly the thesis. I've taken a lot of time explaining our product. It's a multi-cap product designed to have one third large cap, one third mid cap, and one third small cap. And we think that the outcome on this is likely to be quite good, notwithstanding the current correction. And again, the current correction, we are almost on the fag end. We have seen many such cycles in the past, and believe you me, if you really, have the courage to actually buy into this sort of a bloodbath, so-called bloodbath on the street, you will emerge as winners going into the next 2-3 years. The world does exist. The world doesn't come to an end, no matter what the situations are like. And India is broadly a domestic economy, not so much dependent on exports. We produce and consume what we have to do within our country, and it's a country of 150 billion people who have who has an aspiration to consume, earn and spend. These two facts and figures can't be taken away in a hurry, and given all the repercussions, etc., it's still one of the highest growth rate countries in the world. All this will stand in good stead, and obviously, if the froth in the market has got corrected from 26,000 to 22,500, that's a good enough correction. You don't really expect the markets to fall 18,000 and 19,000. That's all the fear mongering on the street. I really don't think all of that is likely possible. So with this, I'll pause and maybe take questions if there are any from our participants. Thank you. Over to you, Kyra.
Yes, sure, Manish. Thank you. Rather insightful, and you always decode everything that is happening in the markets in such a simple way that I think a lot of preempted questions have already been answered. But quickly, Manish, before we move to questions, would you like to throw some more light on the golden decade that you're following? I know you mentioned a few stocks, but would you like to quickly talk about the five themes that you're looking at, or the five trends?
Yeah. So I think basically it's a multi-cap portfolio, and I think the entire opportunity set in India over the next 5 years, which are likely to outperform all other major themes, because there are 52 sectors in India, and plethora of themes likely to play out. But I think the five themes in India's context: one is consumption, one is India manufacturing, the third is energy transition, the fourth is basically financialization of savings, and the fifth is artificial intelligence and digitization. These five themes, broadly in the next 5 years context, will actually outperform India. As far as the last theme is concerned, which is basically AI, that's creating a lot of rumbles in the markets today, with China having its own, deep sea as the large language model which China has created, at a fraction of the cost at what Chat GPT has come through. Mind you, India's IT and telecom minister has also articulated that India will also create its own AI LLM, large language model, and it's only a matter of time. One killer application on AI will create all the differences. And so AI again is a very disruptive force over the next 5 years. That's a very important theme. India manufacturing obviously is known. We have to see how we can take advantage of this, because there is a protective world, there's a tariff-ridden world all over. From liberalization to protectionism, that's the buzzword. And in that quest, our endeavor to move our manufacturing up from around 13-14% to closer to 25% in the next 5 years. So India manufacturing again. India's aspiration to grow a consumer, the middle class. That's basically the bedrock of our consumption theme. Financialization, the share of equities as a percentage of your total household wealth is just about 5%. In the next 5, 7 years, even if this moves to around 7.5%, that would be a 50% increase, and that will manifest itself into many of the stocks and themes that are likely to do well over the next 5 years. So, and energy transition, again, a whole lot of two steps forward, one step backward. Again, today we heard announcements from the power minister talking about rationalization of the debt of the discoms. Again, that's a very good step in the right direction. I think more work in the next 5 years on battery energy storage system, BESS, is likely to be again a game changer. Nuclear power, that's again going to be a new renewable energy, which is presenting itself as a great theme over the next 5 years. So these are the five themes. Multi-cap approach encompasses the entire capital market landscape as far as India is concerned, but very pointed five themes will likely outperform all the other themes in the next 5 years context. That's what we believe. And it is India's golden decade of growth because all other emerging markets have gone through this phase when the per capita income of a country is closer to around 3,000 odd dollars. There is a J curve approach that happens in those emerging markets. It has happened in Brazil, it has happened in China. I don't think why India will not be possible. We ourselves should be responsible if we are not able to make it. What other emerging markets have done so far as the growth rate is concerned, once this trajectory gets achieved. But I think in all likelihood, we are at a very strong inflection point on a very high growth trajectory over the next 5 years. So that is why we have this very good description of the product, which is India's golden decade.
So perfect. Thank you, Manish. And all the participants, if you have any question, you may put it in the chat box or you may raise your hands and we will take a few questions. So Manish, we already have a few questions, which we will take. And like I said, that some things could be a little repetitive. I know we already spoke about, you said that it is about the dollar being more strengthened rather than rupee depreciation. But yet, what do you think can lead to further depreciation in the rupee?
Further depreciation in the rupee could be on account of two things. If we have a major oil shock, if somehow the other oil was to be going up to $100, you don't know. Though it's a very strong likelihood not to happen, and on the contrary, oil should actually fall. But you really don't know. It's a very disruptive world. If we were to get an oil shock, then obviously, we would be very much dependent on FI flows and FDI flows, as was always the case in the past. That whenever oil went above 100, we were always helped by the foreigners, whether it was the FCNRB deposits, whether it was the FDI flows, whether it was the FI. They were always on the positive side. But this time around, it is on the negative side. FIs have sold closer to 3 lakh crores in the last 5, 6 months. You have also FDI not being that strong as it was the case previously. And the rates are also pretty exorbitant when it comes to, let's say, the FCNRB deposits. So on that point of view, we don't have that comfort of inflows of dollars, and we can see a balance of payment issue. We had a balance of payment surplus in the last year, fiscal year 24. We are not likely to see a balance of payment surplus this year. It's likely to be negative 0.5 to 1%. So that's the major issue that we can see, that balance of payment should not be deteriorating massively. That can create further stress on the rupee on the downside. Second is basically all these tariffs, because it's going to be an overhang. How are we going to protect our imports because oil is the major item of import and software is the major item of export as far as remittances are concerned. Plus, we have merchandise exports to the extent of the exports that we do. In this whole backdrop, the tariffs and the retaliatory tariffs is basically going to be quite damaging. So we have to see our merchandise deficit. We have to see our remittance surplus on account of software exports. These are some of the moving parts as far as the rupee is concerned. But I think the spread on the Indian rupee is very, very good. It actually showcases a lot of resilience as far as India is concerned. Typically, for a 4.5% spread, the Indian rupee spread should have been more than 3.5 to 4%. But today at 7%, basically just 2.5%. 10-year yield on the US Treasury is basically 4.5%, and 10-year yield on Indian Treasury is basically 7%. This spread is just about 2.5%. Historically, this number was in excess of 3.5%. So it shows India's strength as far as the internals are concerned. Uh, so that's how it is likely to play out.
Sure. Manish, the next question says that will the online gaming business survive the GST, or does the government want to get out of that business?
It's a bad business. So I don't think minority shareholders generally would make money in that. Because I think the temperament for Indians is unlikely the temperament of, you have the Southeast Asian countries, you have a whole flourishing industry as well. We think slightly differently as far as the online gaming is concerned. That, there's a very fast rate of obsolescence as far as the mindset is concerned. So the amount of money that needs to be spent on, the online gaming, etc., doesn't really justify the efforts, and I think ROCs are going to be minuscule.
Right. Could again be a little repetitive, but on the current scenario, what is the level you see the Nifty in the worst case? Worst case scenario.
Anywhere between 21,000 and 22,000. I, for myself, hand on heart, I would believe that Indian markets below 22,000 is unlikely to sustain for long. You should see a bottom below 22,000, very vigorous buying on below 22,000. In any case, there's a lot of firepower that is still left with the insurance companies in India. And if in January the SIP flows are still 40,000, there's going to be strong buying. Only thing that we need to assure is that this promoter selling and the private equity exits of closer to 2.5 lakh crores, which happened in calendar year 20, that has to be frittered away. We can't allow the promoters to exit, at very elevated valuations, the plethora of IPOs, etc. But I think all things said and done, below 22,000 is a great level to enter. I think in the worst possible situation, you press it the pedal extremely hard on the downside, any level between 21 and 22.
Right. Takes me to a follow-up question here, where somebody is asking that in these markets, should we look at SIPs or should we look at a lump sum investments?
Now is the time to look at lump sum. You should not be. It's like basically playing the game very, very cautiously towards the worst possible situation that you are currently in. It's now really, it would be worthwhile to go all in, because I'm talking about a worst possible situation in the next 5% on the downside. Many times in the past, there were umpteen stories that were written that India is forgotten, and you can't forget India. Leave aside, ignore it for a long period of time. It does come back. You don't know how it comes back. It will come back, and at the end of the day, it serves the purpose of the government of India to keep the markets buoyant. What is going to happen, and this is just blue sky thinking, if they were to just remove some hindrances on the capital gain stack, the FIs who have just fled are going to come running. So, I think it's all about using your mind and your heart at the right time. Today is the time to use your mind more effectively and keep the emotions on the side, because the emotions are all creating negative repercussions. But I think the mind tells you that these are the times to go all in.
Right. We are, obviously talking about the India growth story, and we are saying that this is the golden decade of growth. But what or are there any factors that we hold back the India growth story? And how can we mitigate this maybe on a personal level?
So demographic dividend might become a demographic time bomb. So employability of our youth is the biggest question mark. So obviously, government of India is doing everything that they can to get employment rates up. So disguised employment and unemployment, and a lot of workforce basically stuck in agriculture and not moving to factories and services. That's going to be the biggest risk. But if we have more employable people, and this will be a factor of your education, this will be a factor of your higher education, basically uh, the probationary skills and apprenticeship, all these things, vocational training, these are some of the things which needs to be paid attention. And obviously, incentives are given by the government for employability of employer to employers to employ a larger number of people, because manufacturing sector again endeavor to move from 15 to 25. I think these are steps in the right direction, but you can only take the horse to the water. You can't make them drink, right? So obviously, it is at the end of the day on a personal self whether you want to progress or not progress in life is what is going to determine whether we are going to achieve those rates or we're not.
Okay. There is a question on BSC stock asking that are you still holding it or have you completely booked profits? So,
Completely book
yes.
profits. They completely exited that stock, and I think it's more than fully factoring in. See, it's a very great company. I agree to that. But at the end of the day, NSC to BSC is always 10 is to 1. If NSC is 90% market share, sorry, 9 is to 1. If NSC is 90% market share, BSC is going to be 10% market share, right? And with all these things which have actually played out, you know, at one point in time, nobody was willing to touch BSC at even 500 rupees. Today, people want it at 6,000 rupees. It is similar to a Hindustan Aeronautics, not liked at 4,400 and liked at 5,000. So that's the reason why we think most of the positives as far as BSC is played.
Manish, any views on Ola Electric?
Sell.
Um, Next question that we have is what is the future of gold from here? Maybe in terms of price.
So I think gold has everything to do with whatever you are hearing out of the US, whether the amount of 8,000 tons of gold is there in Fort Knox or not, and whether there's going to be monetization of the gold by the US. All of that is going to have repercussions on the US dollar. But my belief is that gold prices are likely to go up, because sooner than later, if Make America Great Again, MAGA, what Mr. Donald Trump is wanting to achieve, can't be achieved with a very strong dollar. So if dollar has to fall, then everything which is denominated in dollar will go up. Whether it is silver, whether it is gold, whether it is copper, whether it is aluminium, whether it is coal, whether it is oil, everything will go up. And on top of that, if they are doing an audit and they find that 8,000 tons of gold are not there, then all hell will break loose as far as the gold prices are. So net, it's positive for gold price.
Okay. Since you spoke about Trump, we have a follow-up question there. Your perspective for 25, one, Trumponomics impact on the Indian economy, and secondly, the FII outflow reversal expectations in the light of weakening rupee and the supposed trade deficit.
So I think, see, trade deficit, fiscal deficit, all are relative, right? There's also one more theory is that if let's say there's tariffs that is there by US across all countries, and which means that China is also going to face a lot of tariffs. Now, if China has to deal with these tariffs, it has to shift its economy away from exports to domestic consumption. Now they have created so much of huge capacity the world over that they are likely to dump goods everywhere. So growth rates in China is likely to be 2-3% over the next decade. Now China is a very big heavyweight as far as the relative positioning of countries are concerned. So from that point of view, we are quite insulated as far as, let's say, producing and consuming within our. We are more a consumer domestically consuming economy as opposed to export. So we are less vulnerable. So as far as the deficit is concerned, you know, I think the point is not the supply side; it is the demand side. As I said, that increase of deficit is good for growth. Shrinkage of deficit is bad for growth. So I think fiscal deficit, if they were to increase, that's going to be good for growth. Today, the EPS of India is suffering on account of low growth because there is a shrinkage of deficit. So I think if there is an increase of current account deficit, if there's an increase of fiscal deficit, it's going to be good for the stock market as far as India is concerned. But obviously, there has to be a discipline. You can't be running very high deficit because that will eventually lead to a depreciating currency. But everything said and done, I think a 90 on the rupee would not only see the FIs buy long, but they will also run to cover their shorts. Or a level of the Nifty 50 between 21 and 22,000 or 21 and a half to 22,000, whichever comes first could be the worst possible situation where the reversal is likely to happen.
Right. Manish, two questions on where to invest currently, whether it's the small, mid, or large from a 3 years perspective, small cap, mid cap, or large cap. Also, there's a question saying that why do we say that small and mid cap are very risky? Because if when we see in reality, it's your small cap goods that drop 25%, large cap 25%, like your Asian Paints and other stocks. Your large caps are at a 52-week low. So, what are we looking at currently in terms of market cap?
See, everything is basically dependent on how much earnings are contributing to that index. So the large cap index roughly ballpark contributes 50% of corporate profits of India. And the balance is between mid and small cap. So obviously 50% of the market capitalization of India should be represented by large cap. But that large cap segment is growing at 10 to 12%. And that 10 to 12% is being valued at 18 times or 20 times, right? Nifty 50 earnings growth is going to be 10% and is valued at 20. So basically, you are valuing the Indian market at 2 PEG 1 year forward. Now, let's take the same analogy to the mid and small cap segment. Find a company which is growing higher than your Nifty earnings growth. That is higher than 10% and valuation at closer to Nifty earnings. You should be fine. I think there is no risk to the market capitalization of these mid and small caps. And I think over next 3 to 5 years, mid and small caps are likely to give you much better returns than the large caps. It's a given. There's no doubt about that. And there's one more myth that I want to clarify, and that is basically that the large caps are very, very undervalued. If you were to dissect the large caps and take away the public sector units from the large cap index broadly is also trading at 30p. Whether it is the white goods space, whether it is the automobiles, whether it is the IT index, whether it is the pharmaceutical index, whether it is the FMCG, which large cap is trading at very cheap valuation. The overall large cap valuation appears very cheap, because you have the state-owned refineries which are trading at 3-4p, the ONGCs and the IOCs and the power grids and the NTPCs, they are trading a very low valuation. Overall, large cap valuation looks muted, but if you were to dissect and take away the public sector units and just look at the private sector units in the large cap, they are not very, very cheap.
Uh, Manish, there is a question regarding Godfrey Phillips. The Indian government is considering to increase GST on cigarettes. So will that impact Godfrey Phillips?
See, I mean, we are still taxing tobacco lower than many other countries in the world. It is currently taxed at around 57% vis-a-vis France and UK taxing tobacco or cigarettes at more than 80%. And mind you, India, Bangladesh, Nepal, Bhutan, these are basically emerging economies where the tobacco consumption has not yet saturated or come at par with the developed countries of the world. We are still growing tobacco consumption. Of course, there is a lot of health awareness, and the pictorial signs and all of that are representative of the government's duty to warn the citizens. But you could say that given the addictive nature of this industry, every increase in taxation is going to be passed through. And still, you're likely to see a consumption drop in the short term, but it evens out in the medium to long. So people who are used to smoking will feel the pinch as soon as the pass through happens. There is going to be a sharp increase of 5 rupees or 10 rupees on a stick. But since they're addicted to it, they will take it in the stride. So the margins really don't come down. But mind you, what is happening exactly in Godfrey Phillips is that Marlboro, which is their flagship brand, is expanding distribution and taking market share away from ITC just on account of expanding their reach. So if you would have seen the third quarter numbers, the profits grew by 50%. ITC's profit didn't grow by 50%. Why has this happened? Because of the increase in the number of distribution points, right? And likelihood of the slim cigarette on Marlboro, which is being consumed by ladies this year. And it is a big hit as opposed to the brands which basically ITC is offering. Marlboro Slim is selling more than ITC Classic Slim or anything like that. It's a big hit with the female community. So these are the two factors which is basic, and obviously the gross margins and the EBITDA margins in the cigarette business are very, very. So obviously, if you are looking at these sort of growth rates and profits, you are looking at 19-20 P multiples on Godfrey Phillips for a 30% ROE business, where the distribution has still not peaked. The distribution is still growing. And there's going to be high dividend payout ratio because this business does not require capital. Yes, if there is a increase of duty or let's say GST rates goes up to 40% plus specific duties, there's going to be a blip in the short term, but that is going to be true for the entire industry. It's not going to be for only Godfrey. It's going to be for Wazir Sultan Tobacco. It's also going to be ITC. Now, just because the price has increased, will the smoker give up smoking? That's the question to answer. I think it's an addictive industry, doesn't give up so easily. And emerging markets, which is basically your India, Pakistan, Brazil, these are still growing consumption in tobacco, nowhere close to saturation as like the developed markets of the US or UK.
Right, very well answered. I think, Manish, this is something like how we keep saying that Zomato is like a habit forming thing. And, the underlying sector, which is consumption or consumerism, is that we keep talking about. So this is also something we are saying may not run out of fashion so soon. Right. Follow up to that from 25, which sectors or themes will perform well for the next 5 to 10 years? Again, maybe you've answered that, but maybe just another 2, 3 sectors.
I think immediate sector which is not priced in is consumption. The consumption sector was a laggard over the last 2-3 years. on account of very anemic growth and very high valuation. Give it a 2 or 3 quarters, consumption stocks are going to really fly on earnings growth. Plus, when you have earnings growth, you will also see an expansion in values. That's likely to play out. So whether it is a Zomato, whether it is a Pizza Hut, whether it is a Domino's, or whether it is a two-wheeler, an Eicher Bullet Classic 350, or whether it is a Star Health Insurance, these are discretionary money. First of all, the consumer today is very stressed. So first he'll pay his credit card bills. First he'll pay his personal loans. Then after some time, with a relaxed mind, he still has some money on the table. He'll buy a mortgage, still has some money, he'll go in for a few of these things. One needs to see which are the categories where he's going to spend. That depends on the individual customer. These are some of the sectors which are likely to benefit on the consumer discretionary side. Ultimately, it is the consumer who is going to decide whether it is a medical claim which is a priority, or whether it is a travel which is a priority, or whether it is a two-wheeler which is a priority, or whether it is a passenger vehicle which is a priority. That will depend, but overall, this theme is not likely fully priced in to the positivities that are likely to happen for this sector in the next 2-3 quarters.
Right. So I think we are a little suppressed on time now. Maybe I'll take one last question, Manish.
Yes.
But the impact on the Indian economy of the freebies, which becomes maybe a necessity to win the elections.
Yeah, so I think we have to live with this truth, and obviously, all these numbers, all these freebies gets captured in the consumption side of things. Government of India was more focused on creation of job opportunities rather than giving of freebies, and this actually cost them a lot of elections. So, looking at the glass half full rather than half empty, I think giving of freebies will support consumption in a big way. The Manregas of the, remember the Manregas of the world, when the previous government used to dole out a lot of freebies, the consumption sector was firing on all cylinders. Yes, the rupee was depreciating on account of fiscal deficit, but as I said, our foreign debt is not that big, and our domestic debt, we really don't have to worry so much, because the government of India can always print and pay the debt. So as long as more domestic debt and not so much of this, uh, you know, and if you are helping the poorer sections of the society, it's good, as far as we stick to the Fiscal Responsibility and Budget Management Act. That percentage number, which is 4.5, encompasses all the freebies that have been given. But at the sectoral level, thematic level, consumption gets a very big leg up on these women welfare schemes, and the Ladli Behna schemes, and all these will help consumption in a big.
Great. So questions are still coming in, but since you mentioned government, we spoke a lot about equity, but how do you see the new issues market? Will it still take a lot of money from the secondary market?
See, even in the last year, what you saw was the flurry of money that was coming in from the institution side of things. If the FIs were selling in the secondary market, they were buying the primary market. So this is likely to happen even now. I don't think there is going to be great participation from the retail folks, so to speak, or UHNI folks. But this is a very big overhang. If the plethora of IPOs, still gets continued, mind you, there will be very good IPOs that are likely to be subscribed and should be subscribed, because these are great businesses. But just going by last year numbers, the highest number of IPOs in the world, 10% of the total value of the IPOs raised in India, what was raised globally, all these things are quite disturbing. And these numbers will have to come down if we want a revival in the secondary market.
Right, perfect, sir. So I think that brings us to the end of questions. But if any of you still have any more questions, we would love to take that up through an email. You can reach out to us. Always a pleasure chatting with you, Manish sir. Like I said, it
Thank you
is
so much.
you de-jargon so many things, and it's just so clearly visible as to where we are. Because in the current markets, nobody knows where are we headed. When the markets fall, it's going to fall more. Markets moving up, it's going to move up further. So everybody is always confused, and it's always good to listen to you. So yes, thank you everybody for joining us on a Friday evening. It was a pleasure. Both this golden decade of growth that Manish sir manages, we have it on the AIF as well as the PMS platform. And, we would love to connect with you for any more questions. Yeah. Thank you. Thank you, everybody, for joining in today.
Thanks, everybody, for your time. Have a great evening ahead. Thanks. Take care.
Thank you.